Welcome to the Trading Zone. It's just me, Joe Tigay of Equity Armor Investments. Today, this is, of course, the Trading Zone on the Tradier, sponsored by the MyX. So it's a thrill to be here every week. And thank you for tuning in. I'm just going to hang out just here for a second, see if we can get some more folks to join in before I really, truly, fully start the show. So again, just me today. Make sure you say hi. Keep me company here as we're going along here. And I just think it's going to be a great show. Really busy week ahead. Next week, we know is going to be just as busy, if not even busier. And I am here for it 100%. So just can't wait for all the action that's going to happen this week with all the earnings, jobs report, next week with the election. It is going to be a great week ahead. Sorry, I'm just checking out my hair here. Just I can see myself big screen. It's funny to see. Okay, so personal news just out there. Last week, this week, I have been interviewed a few times. This one was a great story in the Wall Street Journal by Sarah Needleman. She was asking about Microsoft. She was curious a year ago how the Activision buyout is going to play out for Microsoft. I told her then, like, that wasn't the reason why I like Microsoft, why I own Microsoft. It's an interesting story. It's an interesting case. I think they could potentially turn it into a moneymaker down the line. But, you know, there's a lot more reasons why I like Microsoft more so than the video game angle. They do have a great products in the video game angle. But she wanted to follow up on that because Call of Duty, there's new series is coming out this week, and they have this streaming service for video games. And I thought that was kind of interesting. And she interviewed me about it. And I think there's potential there. I don't think it's going to move the needle for Microsoft right now. I don't think it's going to be a huge winner for Microsoft today, tomorrow. But I think it's one of those things that could slowly snowball. I do think the video game industry is really big. It's growing. Netflix wants to get into that, but I think Microsoft would have a leg up. They have an advantage if that is going to be a thing, a Netflix for video games. And I think, I think that's a viable option. Also out there in the news, Joe Tigay again being interviewed about Palantir. This time in Bloomberg, people talking about Palantir going too much, too far, too quick. Well, yes, it has gone very quickly. It has gone very high. This valuation is really high up there. So it is, And here's what yours truly had to say about it. Yes, it's come very far, very fast. There's gonna be some bumps along the way. So it's got a very high valuation. So there's going to be volatility. We should just expect that. But bottom line is, she's talking about earnings. What are we going to expect? And it's got an extremely high valuation, in my view, because Palantir doesn't charge what they could charge for their services. They're basically giving away Foundry, and I think they want to just grow their client list. Now, if they were charging what they were charging, I think you might see other companies such as Microsoft jumping in and trying to compete with them, because they would see, oh, this is going to be such a huge business, and I can jump in before Palantir takes over the market and compete on a level playing field. Well, I think Palantir sees the bigger playing field, the bigger picture here. They want to keep their costs low, build their client bases. They feel very confident that they're never going to lose these clients. So eventually they're going to be able to start charging more and more and more. So for me, it's all about the growth of their client base. It's not about how much money they're making now, because they're not in any financial trouble. They're making money. They have cash on hand. They can spend money. So I just want to see them continuing to grow their clients. Worry about profitability later. And this is just a long-term play for me. In the meantime, we're going to see some bumps. We're going to see some volatility. Good news, it's going to send it higher. Bad news is going to send it lower. We can expect that. I just want to see it continue to grow. Remember, it's just at the start for me. We haven't really scratched the surface for what it's going to do. So that was me this week. STS not with us. Brian Stutland, partner. was in Charlotte. He was with our good buddy and also affiliate from RCM Alternatives, Paul Rieger here. They were at an event in Charlotte, and Brian wanted to point out, crucially, you can see Equity Armor Investments right there, and Goldman Sachs right there. So somebody was above the fold and somebody wasn't. So Brian was really excited about that. So yeah, thank you again for joining in. We got a great show today. It's just me. Remember, send in your questions. Here is one from a K. Oh, this is a great question. With the election coming next week, what are we looking forward to post-election? Yeah, there are some stocks to own. There's some market reactions with the election that are going to be fascinating. There's going to be some volatility around the election. How can we expect that? How can we, what can we participate in, and how can we trade that like a week in advance? Is just a fantastic question. I think we should get into that in the show. So now that I've been rambling for about 6 minutes, maybe I can start the show. And thanks everyone for joining in. So this is the Trading Zone. I'm Joe Tigay. This is every Monday at 1 Eastern on the Trader Network. This is sponsored by the MyX. I think I've had too much coffee today. I'm a little jittery here, but I'm having fun. This is talking about the market. This is me talking about volatility. I'm a former options market maker. Traded in the VIX in 2008, 2009, 2010, 2011, in the S&P 500 pit also over that time. So have a lot of experience talking about volatility. And now I'm a portfolio manager. I utilize that volatility skills managing the portfolio. Right now in the market, we're seeing potentially differing signs. We're seeing big signals, big leading indicators. There's a lot to say that the economy is slowing down. Well, is it really? We'll have to wait and see. And does it really mean doom and gloom like we all are predicting? Again, more waiting and seeing. So we are seeing some slowing down in Europe. VW closing some plants. That's not good. Boeing also looking to raise some equity. Not so good. We know Boeing has their own issues. Of course, maybe that's not so economic centric, but we have a huge week this week, and there's going to be a lot of movements. We got the jobs report. We got a ton of earnings this week, some of the biggest names out there. We've got Google, AMD, McDonald's, Caterpillar, Facebook, Microsoft, KLAC, Amazon, Apple, and more. If I missed one, make sure to let me know. We'll talk about that. I'd be happy to. We also still have the concerns for the geopolitical tensions flaring up, Israel and Iran. Election just 1 week away. And also next week, there will be a FOMC policy decision. So there's a lot going on, and it is exactly what we are here for. So not surprising, of course, we have volatility moderately elevated right now. This is a chart of the SKU index. It's something I like to look at every week. We look at this every week. Make sure you check us out every week. The SKU index is a differential between the puts in the S&P 500 versus the calls in the S&P 500. This can be a leading indicator for volatility indexes like the VIX index and the Spike index. So this is something as a volatility trader I pay close attention to. This is on the rise of late, getting a pullback, a slight pullback today, but we're on the elevated end of the recent range here. So this is something, maybe not a huge surprise a week out of the election, but it's something to take into consideration here. So going back to our question with the election next week, and what are you looking out for stocks post-election? Well, for volatility, at least, I have the SKU here. What did we do in 2016? Well, not surprisingly, we had a big spike up into the election in 2016 and then a sell-off after the election. So that is certainly one possibility to see. Again, this is another thing that we saw in 2020. We saw a spike up the start of November and a big sell-off after the election. So it's reasonable to think that that is what we will see again. Two very different results in 2016 and 2020, yet the volatility did a very similar thing. So that is absolutely something to be looking out for. When it comes to the VIX futures curve, it is absolutely reasonable to be saying it is elevated today. We have the red area here is our VIX futures curve. So it is one of the more elevated months, to say the least, or one of the elevated lines here, to say the least. And we have the current spot above the front month future. So people are expecting the spot to come down. Of course, after the election, this front month future won't expire until after the election. So certainly people who are trading this future are expecting this volatility to come lower and even lower still into December. So that's something to watch out for. I also here have the S&P 500 trends here. It's something we've been watching for some time. Man, I'm sorry. I don't know if I'm alone here, but I am getting pestered with election calls here, election text messages. I live in the state of Michigan, and it is just nonstop with pestering. So excuse me for that. Yeah, so this is a 2-year trend of the S&P 500 here. We have this is something I've been highlighting here. I mean, it seems kind of outdated here, this trend, but it's very critical that this former support here, this green line, has turned into resistance. So that is something interesting to me. We're having trouble here, but we're still absolutely expanding here. The trend is absolutely still higher. If you zoom in a little bit closer, though, look at just the 6 months. We had this trend line as something is important here. People we were watching here, we've definitely cooled off here. It makes a lot of sense. There's a lot of just wait and see right now. We're a week out of the election. There's angst, there's anxiety. People don't know what's going to happen, or where to put their chips. And we had that question again about the election. What am I expecting? The conventional wisdom right now, this is just conventional wisdom, not necessarily my point of view, but is that people are expecting deregulation and tax cuts if Trump were to win the election. So that might mean like, a short-term bounce if he wins, followed by a sell-off. People realize, oh, wait, yeah, just because he wants that doesn't mean he'll actually be able to implement that. So a bounce after a Trump win, followed by a sharp sell, a return to the mean, and then the reverse if Harris wins, because those tax cuts people are maybe at 50% or 60% on the table right now, will be taken away. So people will maybe sell the market off after that, and then bounce back to the mean. People realize, hey, it's gonna require more than just a president to implement a lot of these policies. So probably will be business as usual, and we'll get on with it after the election. Again, we'll wait and see. And maybe this will kind of all be condensed into the overnight trading hours, and it won't even be available for most people to trade during the day. Again, we'll wait and see, but it doesn't make sense to make a huge bet either way. Even if we knew the outcome, it doesn't really guarantee what the result for stocks will be. A sector, of course, that I've been watching very closely is the semiconductor. And wow, these semiconductors have been doing fantastic this year, but we've been, consolidating really for half the year here for the semiconductors. We haven't really been making new all-time highs like the rest of the market. It would be great to see this being the leading indicator. For me, if the market is going to get back on that trajectory, get back into that upper echelon of the gains, we need to see the semis leading the way. It's kind of a worrying sign that it's not leading the way, to be honest with you. But that doesn't mean that it's not going to happen. Still, great results from Taiwan Semi, 2 weeks ago now. So it's very possible that it could still happen. You have AMD coming up this week, so we'll see. We'll see if that changes anything as we go. Plus, all the rest of the earnings, people could be talking about how many chips they're buying or their build out in their AI data centers. So that will be a lot to be watching here. Again, want to see this continue higher, make a higher high here. That'd be step number one, and then an all-time high, step number two. So anyways, let's get on to the big story. There are a lot of factors out there saying, hey, the economy is slowing down, a recession is imminent. Well, great question, but is this different? Is this time different? Well, one of the factors that could lead to a recession is, of course, an oil shock. Well, thank goodness as of late, that has not happened. I just want to warn people that this should still be on everyone's radar. Israel, Iran, they had their recent spat. Hopefully, it's all done. There's no more follow through on the follow through. But if Iran were to decide to close the Strait of Hormuz or escalate the conflict further, this could cause a major shock. And they don't even, I might think of it and look here objectively and say, what can they really do? Well, even if just threatening to do so would cause a major shock, because just the mere threat of it would cause fewer people to want to ship through there. The insurance of shipping through there would skyrocket. Those tankers are so expensive. So just the mere threat that one could be blown up or stopped or hit a landmine or whatever would really send the prices through the roof. So that's just something we need to be aware of. It hasn't happened yet. Hopefully it doesn't happen, but it's just one thing to be watching. Now, another thing that a lot of people have highlighted and pointed out is the yield curve. Now, the yield curve, of course, is a graph that shows interest rates for bonds with different lengths of time. Now, this usually is so from short term to long term. Normally, bonds that last longer pay a higher interest rate because people expect them to earn more if their money is locked up for a longer period of time. So normal yield curve is upward sloping, meaning that the short-term bonds have a lower interest rate than the longer-term bonds. Now, sometimes the pattern flips. This is what is called an inverted yield curve. This happens when short-term bonds have higher interest rates than longer-term bonds. Now, an inverted yield curve can be a warning sign because it means that investors are worried about an economy slowing down. They expect interest rates will drop in the future, possibly due to a recession. So they're willing to accept lower returns on long-term bonds. When the yield curve goes from inverted back to normal, now this shift is often a signal that a recession could be coming soon. Historically, this pattern has often occurred just before a recession hits. Now, here's why. The economy starts to slow down. Central banks lower their interest rates to make borrowing cheaper and encourage spending. This causes short-term rates to fall, making the yield curve return to normal in an upward sloping shape. Now, this reversion to a normal yield curve could be the final signal that a recession is on its way. The economy is already slowing down enough that the central banks, the Federal Reserve, needs to support it. So that's what we're watching here. And it's no surprise here that unemployment follows very closely here. You can see, when the yield curve reverts to normal, you get this unemployment going higher, like it did in 2008, like it did in 2000, unemployment going up when the yield curve reverts to normal. So it's just something to watch out for. It's happening right now. I don't know if this time is different, but of course, we just had the yield curve go from negative. Now it is positive, and we're starting to see just this first warning sign that unemployment is on the rise. Now, another thing that people have talked about when it comes to leading indicators and this current economy is that the banks have been tightening as of late. So this is why tightening banks can be a problem. So when banks make it harder to get loans, it's called a tightening of their lending standards. This means that the banks only lend money to people or businesses with very good credit or people who seem less risky. Banks usually tighten their lending standards when they worry that people or businesses might struggle to pay back loans. By lending less, they protect themselves from losing money if the economy slows down. When fewer loans are made, people and businesses have less money to spend or to invest. For example, a business might delay their spending. People might put off a big purchase, like buying a house, buying a car. When spending slows down, it leads to slower economic growth, sometimes a recession. This is because the economy depends upon people spending money and businesses growing. So when banks tighten their lending, it can be a sign the economy is getting weaker, which often happens before a recession. So this is something, of course, that happened in a big way last year. It's already turned around. These are the times when the economy got very tight. And you can see, not surprisingly, shortly thereafter, unemployment started to rise. So here we're in the spot where we were tight. We would expect to see shortly thereafter unemployment start to rise. Finally, I also have for you Exhibit C, leading indicators. Leading indicators are economic measurements that can help predict what might happen if the economy slows soon. Some examples of leading indicators are new orders from manufacturing, building permits, stock market performance, consumer confidence. These indicators are like clues that show whether businesses and people feel positive or negative about the economy in the near future. When leading indicators start falling, it usually means people and businesses are spending less or holding off on big purchases or investments. For instance, businesses might receive fewer orders. They might slow down production. They might slow down hiring. Similarly, if fewer people are applying for building permits, it might mean that fewer homes or buildings are being constructed. Falling leading indicators can be a warning sign of a recession because they show the economy is actively slowing down. If these indicators keep dropping, it might mean that people expect harder financial times ahead, which can lead to an actual slowdown and a recession as spending and investment decrease across the economy. So finally, no big surprise. Put in the unemployment rate here. Yes, of course, as these leading indicators are falling, you can see, of course, the unemployment rises at the same time. So this is obviously 3 for 3, 3 things we have in the current economy right now, which could be very troubling in terms of a recession. I know there's lots of optimism. A soft landing is coming, but these are 3 major reasons to think that it's not. Now, the one thing that is different, if you go back in 2008 and 1991, we had the recessions then. The one thing that is not quite the same is deficit spending. So I have up here deficit spending as a percentage of GDP. And it's kind of hard to think about exactly what this means. I know there's, this is very charged issue, but government spending can boost the economy. It puts money directly back into jobs and services. Maybe that's not what happened recently, but it certainly can be a tailwind to the economy. It can lead to more jobs. It can lead to more spending across the board. So it kind of replaces some of the slowdown in the economic activity. But usually this is happening in the middle of a recession. Usually this government spending happens after the economy is weakened, not before the economy has weakened. Certainly you can argue the recent inflation that we've seen was a direct result of the COVID spending. Now that might have been a one-off, very unique situation, but we're certainly in a spot still where we are spending a lot more money than normal, at least on a historical perspective as a percentage of GDP. The GDP, of course, is higher now. The government's still spending a lot more than historical normals would suggest. And I think that might offset some of these major headwinds for the economy, this major tailwind here from the government spending. We'll wait and see what actually comes to pass here. Of course, this kind of is a different look when it comes to the unemployment. So yeah, I think there's potential here for this government spending to actually be a tailwind and maybe deflect against a lot of this, against these leading indicators, that deflect against the 210 curve. Let me know what you think. Do you think that this government spending can actually make this time different? We're just spending a lot more than normal here. Now, I know this can be kind of a charged issue, and I hope I'm not misinterpreted here when I make this statement. So this, of course, government spending can be a serious long-term challenge here. We got massive spending here. There's no denying that. We had massive spending here with the TARP, massive COVID spending here. This is kind of recessionary spending when we're not really in a recession right now. So, and I don't really see any signs of this slowing down. This is something we've been talking about in the on our program for some time, but I don't see in this political climate, it's very unlikely in the near future for this to stop. And I feel like this is a bold prediction here, but I want to emphasize that this is not me taking sides, just kind of like me objectively looking at the data here and what's happened historically recently. So both political parties have a tendency to want to spend money. As you can see in this chart, this is really bipartisan. Spending goes across both parties. But contrary to predictions or the conventional wisdom that the Republicans prioritize economic solvency and controlled spending, I think that if there is a improvement on this area, spending will slow down more, is if there's a divided government and Harris wins the presidency. I think Republicans will want to lean more on their fiscal solvency as their in that circumstance. I think we're going to see more of the deficit fights if that was the case now than if Trump were to win. If Trump were to be the president again, and I don't see that fight happening as much. I see a clear path to spending as usual if he's the presidency. So maybe that's good in some ways and bad in other ways. I think long term, this is a problem that has to be solved. The spending has got to come under control. So we'll have to wait and see what exactly comes of that. So with that said, I do have a big trade of the week. Microsoft is coming up. They are going to be having earnings. I'm really excited to see what they come up with here. You can see here recently, not a ton of movement here lately, kind of flat here. The implied move is about 4%. Average move is about 3.5%. Consolidating here, just like a lot of the chips have been for the past 6 months here, three months here. So I think kind of we're in the middle end of this range. I'd love to see it back up here, but I don't think this earnings is going to have a huge move one way or the other. I think we're kind of in the middle of this range. I'd like to have a little protection here to the downside. So I have a stock replacement trade strategy, just an idea, not an actual recommendation, something I'm looking at though, with Microsoft at 428.25. Again, we had the average earnings was 3.5. The implied earnings was 4%. I'm just kind of looking at a strategy I can get out of the stock, make some money if nothing happens, have that upside participation if it does go up, and get back into the stock if it pulls down. So I'm going to do this by selling the 425 put, buying the 430, 460 call spread. Now I get to collect $1 to do this. I think that's great. I will be better off by $4, $3.5, $3.25 if we go lower. I get to collect my $1, and I'm not, taking any losses until really 424. So it's 4.25 better to the downside. So that's great. And to the upside, I'm only really worse off if we trade above 461 before the end of November. So I think that's a great do for me. I would much rather have this trade on than than owning the stock. Remember, their dividend actually doesn't come due until after this expiration. So there's just a fantastic trade-off for me. Get out of the stock, put this on, more cushion to the downside if it goes lower, essentially a better upside unless we have almost a 10% return in a month. And honestly, if Microsoft were to return 10% in any one month, I think it'd be a good sell anyways, or a good time to take some deltas off anyways. So I really like that trade for that reason. I really think this is a good do personally, not a recommendation again, but something I'm looking at. And if you have any thoughts, comments, questions, feel free to contact me. I want to thank everybody for tuning in as usual. It really is a lot of fun to do this show. I do it every Monday, 1 Eastern. My name is Joe Tigay. You can check me out at equityarmorinvestments.com. You can get a free book there. And you can also check me out at Twitter at Joe Tigay. Again, comment, questions every week are always welcome. Happy to talk it through. But it's wonderful to be here every Monday, and I look forward to doing it again next week. Have a great week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.